Welcome to the deep dive. We're here to cut through that whirlwind of information you get, especially in the financial markets. Things change so fast.
They really do. Lightning speed sometimes.
Exactly. So today we're taking a strategic look ahead. We're zeroing in on the week of July 14th through the 18th, 2025.
Right.
And this isn't just, looking back. It's a forward-looking analysis. We've distilled it from an expert briefing report, really designed to give you, our curious learner, a bit of an edge.
Yeah, absolutely. And if we connect this to the bigger picture, the week we just finished, ending July 11th, it really felt like the market was just holding its breath, a nervous pause. That bullish momentum we'd seen before, it just stalled out, mainly because anxieties around international trade and tariffs suddenly jumped right back into focus.
Yeah, they overshadowed everything else for a bit there.
They really did. What's striking is, despite some genuinely strong economic signals underneath it all, those trade fears just completely hijacked the narrative by the end of the week.
Which sets up a pretty tense backdrop for this coming week, doesn't it? Because critical inflation data is about to land, and it feels like that's going to be the main driver now.
The absolute main driver, I'd say.
So what are we going to unpack for you today? We'll dive deep into the big themes, that ongoing AI revolution, sure, but also the health of the U.S. consumer and what to expect from banks and the financial sector as earnings kick off. Our mission really is to equip you with a clear roadmap, help you navigate the opportunities and, yes, the risks in the days ahead.
Let's do it.
Okay, so let's rewind a bit and unpack that roller coaster we just had last week, ending July 11th. It started with so much optimism, didn't it?
It really did. Almost euphoric for a moment there.
Yeah, the momentum from that strong June jobs report, what was it, 147,000 new jobs, unemployment down to 4.1%.
Yeah.
That actually pushed the S&P 500 and the NASDAQ to new all-time highs on Thursday, July 10th.
Right, record territory.
And get this, in that surge, AI chip maker NVIDIA, actually hit a staggering $4 trillion market cap.
Incredible number, a real symbol of that AI boom confidence.
But that confidence, well, it proved incredibly fragile. That upward trajectory slammed into reverse almost immediately. Why?
Yeah, the trigger was the White House suddenly escalating its trade rhetoric. We got specific reports, didn't we? Oh. Potential 35% levies on Canadian goods.
Right.
And then that broader threat, raising baseline tariffs to maybe 15–20% for most trading partners, that just instantly reignited those deep-seated fears about inflation.
Completely overshadowed the good jobs data. It was like a switch flip.
Exactly, like a giant inflation risk alarm bell just started ringing really loudly across the market.
And you could feel that anxiety almost immediately, couldn't you? By Friday, July 11th, the major indices had given back all those gains from Thursday.
Oh, gone.
The S&P 500 finished down, about 0.25% for the week. But look at the Dow Jones, often seen as more tied to the traditional economy. It fell over a full percentage point.
Yeah, that tells you something, doesn't it? The trade fears hit those cyclical industrial names harder. Yeah. And this shift, it had a huge immediate impact on the bond market. It moved decisively, priced in higher inflation risk just like that.
So what did that look like?
Well, the yield on the benchmark 10-year U.S. Treasury note, that's a key indicator for borrowing costs everywhere it shot up. Over 8 basis points across the week. Closed near its highs, around 4.43%.
Wow. So the bond market's basically saying, okay, inflation risk is back.
Precisely. It's repricing that risk very quickly. And that could impact everything from mortgages to corporate loans down the line. And at the same time, the U.S. dollar index, the DXY, it strengthened. Went up to 97.87.
The flight to safety.
Classic move. Investors get nervous. They often pile into the dollar.
So how did different parts of the market react? You mentioned that rotation. What did the sector performance look like?
Yeah, it painted a really clear picture. We called it an inflationary risk-off rotation. Yeah. The clear leader. Energy. WTI crude futures jumped almost 3% just on Friday, selling around $68.45 barrel. Industrials also showed some pockets of strength. Airlines were notable. Delta, DAL, gave a really robust outlook for the rest of 2025.
Oh, interesting.
Yeah, that sparked a rally in airline stocks, lifted United, UAL as well.
But who are the laggards? Where did the money flow out of?
Well, conversely, the sectors that are really sensitive to rising rates and economic jitters, they underperformed significantly. Financials lagged, partly nervousness before bank earnings, I think.
Makes sense.
Consumer staples and communication services were also weak. And the underperformance of staples, the defensive names, that was particularly telling.
Why is that?
It suggests concern not just about consumer demand maybe softening, but also about corporate margins getting squeezed. If companies can't pass on those potential tariff-related cost hikes.
They get hit from both sides, lower demand, higher cost.
Exactly, a margin compression story.
So ultimately, the market just couldn't hold on to those record highs, even with strong job numbers. It really exposed a kind of brittle psychology, didn't it?
It really did. It's like investors were operating on a trust but verify basis with the economy, and any hint, any flicker of an inflation threat just instantly overrides months of positive growth data.
Yeah.
It wasn't just a typical dip. It really highlighted how deeply that Goldilocks story, disinflationary growth has been ingrained. So any challenge to it hits disproportionately hard.
So the market showed it's more fearful of future inflation than confident in the present strength.
That sums it up perfectly, and that really sets the stage for this coming week.
Okay. So if last week was that reality check, the Goldilocks dream getting challenged, what does this week hold? July 14th to 18th.
Yeah, this week feels like the ultimate trial, maybe. It's poised to be pivotal. It's dominated by critical U.S. economic data releases that are going to directly test those inflation anxieties that flared up last week.
That data onslaught.
Pretty much.
Yeah.
And it's coupled with the official start of the Q2 2025 earnings season. Crucial focus there on the major banks that really act as a real-time barometer for the U.S. economy.
Right. So leading that data parade, the big one everyone's waiting for, Consumer Price Index, CPI. That's for June, dropping on Tuesday, July 15th.
That's the one. The main event.
And the consensus forecasts, they're anticipating an acceleration. Headline inflation maybe ticking up to 2.6, 2.7% year over year. That's up from 2.4% in May.
And the core rate, which strips out food and energy.
Right. The Fed watches that closely.
Exactly. That's expected to retest the 3.0% threshold. So the implications are pretty clear. A hotter than expected reading confirms the fears.
Which means?
Likely means higher treasury yields, more pressure on stocks, especially those high-duration growth and tech names. They're super sensitive to rising rates because so much of their value is based on future earnings.
Okay. And conversely, if it comes in cooler.
Well, a cooler print could spark a substantial relief rally. Big sigh of relief across the market.
Got it. So CPI is Tuesday. What follows?
Wednesday, July 16th, we get the Producer Price Index, the PPI, also for June. This gives us more clarity on the inflation pipeline. Think wholesale inflation, what producers are paying.
Okay. So if CPI is hot and PPI is hot.
That's a particularly bearish signal for corporate profits. It suggests firms are facing rising input costs, and they might struggle to pass those on to consumers without, hurting demand.
That's a tough spot.
A margin squeeze again.
Exactly.
Then Thursday, July 17th, we get retail sales for June. This is our check-in on the U.S. consumer's health.
Critically important, especially after that surprising drop last month. Remember that. 0.9% decline.
Yeah, that raised some eyebrows. So what's expected this time?
Expectations are pretty modest, just a 0.1% rebound. So you really want to watch this for any signs of consumer fatigue. Is the spending slowing down?
What if it's weaker than expected?
That would amplify concerns about a slowdown, maybe cap any market rally. But if it's stronger, well, that signals resilience, but it could also be seen as inflationary.
So it's tricky. A strong number isn't necessarily pure good news if inflation is the main worry.
Exactly. It's a bit of a tightrope walk for the market's interpretation there.
Okay. Any other data points we should keep an eye on? Yeah, a few others will round out the picture. We get industrial production and the Fed's Beige Book on Wednesday. Thursday brings the Philly Fed Manufacturing Index and initial jobless claims.
Jobless claims, always important.
Always. And Friday, we get housing starts and the preliminary University of Michigan Consumer Sentiment Survey. Pay close attention to the inflation expectations component in that one.
Right. What? Q2 season kicks off.
Yes. And it begins in earnest, giving us that real-time corporate health check. The big U.S. banks are up first. JPM, Bank of America, Goldman, Citi, Wells Fargo, Morgan Stanley. They report throughout the week.
So for you, the listener, observing these bank earnings, what are the key things to watch?
Okay, number one, net interest income, NII, and net interest margins, NIMs, crucial metrics. They tell us how much profit banks are making from lending versus what they pay on deposits. We want to see the real impact of these sustained higher rates.
Makes sense. What else?
Loan growth and credit quality. Are loans still growing? And critically, are banks setting aside more money for potential loan losses? Any increase in those provisions signals rising stress in the economy.
Okay.
Also, investment banking and trading revenue gives a sense of capital markets activity. And maybe most importantly, listen really closely to what the bank executives say in their commentary about the overall health of the economy. They have a unique vantage point.
Good point. What about outside the banks? Any key tech or consumer names reporting?
Yeah, a few bellwethers to watch: Netflix, NFLX. The focus there will be global subscriber growth, how that ad-supported tier is performing, and their guidance on spending and profits in that really competitive streaming world.
Okay.
And then, crucial for the whole tech ecosystem, TSMC and ASML. These are the linchpins of the global semiconductor supply chain.
Huge players.
Absolutely. Their results and outlooks, they're a global barometer for chip demand for the whole AI investment cycle. What they say will have ripple effects across the entire tech sector. It's a direct read on AI spending health.
Got it. And thinking globally, what else is on the radar?
Well, the primary global factor is still the uncertain path of U.S. trade policy. Markets are just on high alert for any new tariff news, especially regarding the European Union. That August 1st deadline for reciprocal tariffs, that's looming large, a big market overhang.
Right, that hasn't gone away.
Not at all. Also, expect a lot of Fed speak. We've got a packed schedule of speeches from Fed officials: Bowman, Barr, Collins, Logan, Williams, Waller.
The whole crew.
Pretty much. And the market will be parsing every word for any shift in tone after they see this week's inflation data. And don't forget, global monetary policy divergence. Other central banks might be on different paths than the Fed, creating interesting currency dynamics.
Okay, wow, so there's a lot swirling around. With all this complexity, where should you, the listener, be focusing your lens this week? How do we make sense of this for specific stocks or sectors?
Right, so we've tried to group key stocks by how sensitive they might be to this unfolding story, to give you that clearer lens.
Okay, let's break it down. First up, the AI ecosystem. Names like NVIDIA, Microsoft, Google, AMD, Broadcom.
Yeah, this group, the market leaders, their main test this week really comes from interest rate sensitivity. Fundamentals might be good, like NVIDIA getting approval to sell certain chips in China. That's a plus.
Right.
But their high valuations make them really vulnerable if Treasury yields spike. So a hot CPI report could easily trigger some profit-taking in these names.
And those TSMC and ASML earnings you mentioned?
They provide that direct read on the durability of the global AI investment cycle. Very important context for this whole group.
Okay. Next group, the consumer pulse. Thinking Amazon, Target, Costco, Walmart, Nike, McDonald's. What's the focus here?
Focus is squarely on gauging consumer health. Two things mainly. First, how the market digests Amazon's Prime Day results. Early reads suggested maybe mixed results. Lower spending per transaction. That's an interesting signal to watch. Second, the big macro confirmation from that official June retail sales data on Thursday. If that report comes in weak, it raises serious questions about consumer resilience across the board. It hits this whole sector.
Got it. How about healthcare? Companies like Eli Lilly, J&J, AbbVie, Vertex, Pfizer, Medtronic.
Yeah, in a nervous market like this, healthcare could definitely reemerge as a defensive haven. Money might flow there seeking safety.
Makes sense.
But beyond just defense, you also want to focus on stock-specific innovation. We're seeing real catalysts, like Vertex getting its non-opioid pain drug Journavex approved. That's big. Or Eli Lilly with its dominant GLP-1 drugs for diabetes and weight loss, plus positive news on its Alzheimer's drug.
So these names offer potential growth separate from the big macro swings.
Exactly. Potential alpha, less correlated with whether CPI is hot or cold. They can kind of dance to their own beat, driven by innovation.
Interesting. Okay, financials. You said they're at the epicenter this week. JPM, Bank of America, Goldman, but also PayPal, Amex, Visa, Morgan Stanley.
Truly at the epicenter. Bank earnings give us that first comprehensive look. How are higher rates really impacting net interest margins, loan growth, and, crucially, credit quality? Are defaults ticking up?
And you mentioned PayPal specifically.
Yeah, there's that interesting competitive disruption story playing out. That JP Morgan PayPal data fee issue. It potentially poses a significant new structural headwind for PayPal's whole operating model, something to watch closely in their results and outlook.
And the payment networks like Visa, Amex.
Highly sensitive to that retail sales data. Their business flows directly from consumer spending volume, so they're watching Thursday's report very carefully.
Okay. Finally, the industrial and cyclical barometers. Thinking Caterpillar, Deere, Delta, Union Pacific, FedEx.
Yeah, these are direct proxies for economic growth, so super sensitive to the inflation data. A hot CPI or PPI implies a more hawkish Fed, right, which raises recession risk. That's a headwind for these guys.
So that strong momentum we saw in airlines like Delta last week.
That gets tested against this broader macro reality this week. Plus, the industrial production report on Wednesday gives direct insight into manufacturing health. Are factories busy or slowing down? That matters for names like cat and deer.
Okay, that breakdown is really helpful. So, looking ahead, how might the market react based on how this data plays out? You mentioned scenarios.
Yeah, the market's reaction is likely going to hinge on that interplay between the inflation data, primarily CPI, and the consumption data, the retail sales number. This sets up a few plausible scenarios for how you might think about positioning. We want to equip you for these possibilities.
All right, let's walk through them. Scenario one.
Okay, scenario one. Hotter CPI comes out Tuesday, combined with weaker retail sales on Thursday. This is the most bearish outcome, kind of a stagflationary signal, inflation rising, but growth sputtering.
Not good. What happens then?
Treasury yields would likely spike higher. The U.S. dollar would probably strengthen as investors seek safety. And in terms of stocks, this favors defensive positioning. Think utilities, maybe select non-cyclical healthcare names.
And the losers?
High-duration growth assets, especially tech, would face severe valuation pressure from those rising yields. And cyclical sectors that need strong growth would also suffer badly.
Okay, that's the grim scenario. What's the opposite? Scenario two?
Scenario two, cooler CPI reading, coupled with stronger retail sales. This is the most bullish scenario, the Goldilocks signal.
The soft landing dream comes true.
Potentially, yeah. It could catalyze a powerful risk-on relief rally, really reaffirm that narrative that inflation can cool without killing the economy. In this case, you'd expect Treasury yields to fall and a broad equity market advance.
Led by?
Led by the very sectors that were most at risk in scenario one. Technology, consumer discretionary, other growth-oriented segments. It's the market basically sighing in relief.
Okay. And what if the data is messy? Scenario three, mixed data.
Right. For example, maybe you get a cooler CPI, which is good, but then you also get weaker retail sales, which raises growth concerns. This kind of outcome creates a much more complex, probably volatile trading environment.
So uncertainty reigns.
Pretty much. The market would be weighing easing inflation against a slowing economy. That could lead to choppy, range-bound trading, maybe a rotation into quality and value factors as investors struggle for a clear direction and try to balance growth and defense.
And that global monetary policy divergence adds another layer.
Exactly. Adds another layer of complexity to navigate in that mixed scenario. Different central banks doing different things complicates the global flow of capital.
Okay. This is incredibly helpful context as we head into such a critical week.
Yeah, it's going to be fascinating to watch unfold.
So as we wrap up this deep dive, the key takeaway seems to be this upcoming week isn't just about the numbers themselves. It's really about the market's ongoing struggle, isn't it? Trying to reconcile those fears of future inflation with the underlying economic strength we've seen.
That's it, exactly. The CPI report on Tuesday is absolute key. It sets the tone. But the subsequent data, like retail sales and, importantly, the corporate commentaries from earnings, especially the banks, that will tell the full story.
It's the whole picture, not just one data point.
Right. So a final thought for you, our listener. As you reflect on these possibilities we've discussed, the data, the earnings, the scenarios, what stands out to you as maybe the most surprising or the most crucial piece of information that could truly shift the balance this week?
And maybe think about how you might apply this deeper understanding. How does it change how you view the economy, or maybe even your own choices?
Great questions to ponder. We really encourage you to keep that curiosity burning, stay informed, and continue your own deep dives into the world around you. Thanks for joining us.